From the Lineweaver Wealth Watch Center, this is the Financial Quarterback.
I'm Jim Lineweaver, your financial quarterback since 1993. Right now, we know that the Iran conflict is at the top of everyone's mind. And while we've put out several segments, videos, and articles, we also want to keep the back half of the year ahead of us, and that means the effects of the midterms on the market. So today, we're talking about a pattern in the stock market that tends to get attention during election cycles. So how the market has historically performed around midterm elections. Looking back at all the 19 U.S. midterm elections since 1950, the year after the midterm election was positive every single time. And on average, the market returned about 14.8% in the year after the election, compared to about 3.5% in the year before. So that is a meaningful difference, and one that has shown up with surprising consistency over time. What makes it even more interesting is that volatility was nearly the same in both periods. In other words, the stronger post-midterm results were not driven by a dramatically calmer market, but by meaningful, better returns. So risk-adjusted performance improved sharply once the election was behind us, which suggests that the market has historically rewarded investors more efficiently in the year following the midterm election. Why might that happen? One common explanation is uncertainty. In the months leading up to the midterm election, markets are trying to assess possible policy changes, shift in congressional power, and what those changes could mean for taxes, spending, regulation, and the broader economy. Once the election passes, some of that uncertainty begins to clear. Investors may not get everything they want, but they do get more clarity. And historically, markets have often responded well once that uncertainty begins to lift and the investing environment becomes a little easier to assess. Importantly, this does not appear to be simply a Republican or Democratic pattern. The data suggests this has been more structural than partisan. In other words, the historical tendency has not depended so much on which party wins, but rather on the fact that the election is over and the market has a better sense of the path ahead. It is also worth noting that some of the strongest post-midterm gains come after especially weak markets. Years like 1962, 74, 2002, 2022 saw difficult pre-midterm periods followed by strong recoveries in the year after the election. That suggests the post-midterm period has often combined two forces: relief from political uncertainty and a rebound from depressed market conditions. Another interesting part of the data is that the year before midterms has often been much less reliable. The average returns were lower, drawdowns were deeper, and outcomes were far less consistent. So by contrast, the year after the election produced not only stronger average returns, but much more dependable results across cycles. At Lineweaver Wealth Advisors, we help investors stay focused on long-term strategy, especially when headlines and market swings create uncertainty. To learn more, visit lineweaver.net or call the number on your screen. Here's Fox News Sunday.